Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. AM on the East Coast, we got a real humdinger here from Market Call, all on the back of comments made in the White House, the Oval Office last night at approximately, if I'm not mistaken, Dan, 5:30-ish, maybe, I'm ishing now. Seemingly taking, I think in response to a question about Jerome Powell, President Trump said he never had any intention of firing him, which, okay, that's fine. And then obviously what the other thing that caught people's attention was a bit of a softer stance in terms of China and tariffs, and see the market acting in kind. We have an S&P up 3%, Dow up 2.5%, NASDAQ up almost 4%, a VIX down, but still above 27. So a lot to discuss as usual.
Yeah, I mean, listen, yesterday was a really interesting day. The fact that Bessent was behind closed doors meeting with JP Morgan's largest institutional clients, and to make that sort of commentary to that group, they talk so much about Wall Street versus Main Street, all that sort of stuff. And, we're here for Main Street, not Wall Street. Bessent was clearly there for Wall Street. All that talk about we don't care about the stock market, and then to make those sorts of comments, this is starting with Bessent in the morning, right? And then after the close, and we talked about it during Fast Money, I think you said it or Mel said it to you, and you agreed that, Eamon Javers from CNBC, great Washington reporter, was ushered into the Oval Office, given the opportunity to ask Trump a few questions. And of course, the first question out of his mouth is going to be that was a total setup. Like, think about it, right? The way in which Trump spoke about, listen, that's great. You and we don't want Powell to be fired. We think that would be a huge mistake for them to go down that route. But I guess just the goofiness of being so tough about China tariffs, being so tough about, firing the Fed Chair Powell, and then just casually walking both back in the Oval Office. What leads you to believe that he won't just do an about face on all of that? I mean, that's the thing that is really sort of annoying. We know that this is how this White House operates. We've seen it before, but this is just so much worse to me. It's so much more obvious. I don't know. Thoughts there, guys?
Well, that's why. I mean, that's why it's
the morning, and I don't like the afternoon.
Yeah, that's why it's so difficult to try to sort of handicap what's going on a day-to-day basis. I mean, Amanda can throw up the slide we have about Jerome Powell, but I mean, it was, listen, the tweet or whatever the word is these days that President Trump put out about Jerome Powell over the weekend. I think it was over the weekend. I lose track of time.
Monday morning. It was
something
Monday
to the effect of, I can't wait. I look forward to his termination, I think is the language I'm paraphrasing. So, I mean, termination, obviously, there's a connotation to the word termination. And you can say what you want in terms of he never had any intention. I mean, the language is what it is. Now, I think what happened, and again, somebody, cooler heads prevailed and said, listen, this would create quite a disturbance in the bond market. It's going to do exactly the opposite of what you want to happen. So maybe he took it under advisement and he's walked it back, which, by the way, again, if he's listening to people, I think that's a good thing. But to your point, it's very hard on a day-to-day basis to try to figure this out. And, the cavalier attitude around all of these different things that matter, by the way, to a lot of people is, in a word, frustrating. But listen, again, this is the market that we find ourselves in, which is, again, one of the reasons why, despite the fact that the market's up significantly, you still have a VIX that's elevated by all stretches of, historical norms.
Yeah. What I found actually most troubling about the whole conversation, or all of these comments yesterday, and listen, let me be very clear. I'm perfectly happy that the stock market is up here. You know what I mean? The idea that we're kind of out of panic mode. I know we're going to look at the 10-year yield. I know we're going to look at the dollar. And, that was my, comment yesterday when we were discussing at 5:15, the rally that we had before that commentary came out. I said, more importantly than the stock market is keep an eye on the dollar and keep an eye on yields. Dollar's up a little bit right now. Yields are down a little bit. Great. Okay. But the most troubling thing that I found about that commentary guy is that, if they don't lower yields, or rates, it's not the end of the world and we'll be just fine.
We'll be just fine.
I mean, listen, everyone knows how I feel about the guy. That is sociopathic behavior about the global economy, about the global markets and stuff. I mean, really, I don't think there's any other way to categorize that. So, the VIX can only go to 20 or below 20, guy, if he just shuts his mouth and lets cooler heads prevail. You know what I mean? Which is the term that you just used. Let's get some bilateral trade deals done first with our allies, right? Get them behind us a little bit, and then take care of the big kahuna. But I also think it's important to remember that in the first administration, we slapped tariffs on China in March of 2018. They did not have a handshake deal for the first phase of this trade, deal that they did. You ready for this? Until January 2020. Okay. So nearly 2 years. So to think that we have ratcheted up these tariff rates and all the rhetoric around it, I would say it's like 5x of 2018. And you think you're going to have some grand deal? So to me, I don't think there's going to be any tooth to any of these. We're going to get a good, preview of this when we have some framework for Japan or some framework for India, because those are the ones that they keep indicating are coming soon.
Let's open S&P chart because, you can see all the noise that's taking place below the 200-day moving average, which, by the way, without question is flattening out and is turned lower. You still have that 50-day. We don't see it here, but I will tell you, the 50-day has crossed the 200-day on the downside. And if Amanda wants to do another chart showing that, that's fine. I mean, we have said on a number of different occasions that you're going to see a lot of noise down here. And, the market I thought could get up to 55 and a quarter or so. It's got close, traded off again. We're right back up around it. I mean, I guess the question now is, given what we've learned over the last 24 hours, and again, subject to nothing further, which is a big subject too, can we sort of levitate up to sort of 5,700, which will be the 200-day moving average? Yeah, I guess in the absence of whatever, you could probably do that. But I want to be crystal clear. All this stuff to me is the headline, but the real story lies in terms of the slowdown that we're feeling and the fact that despite this sell-off, the market, in my opinion, is still way too expensive.
Yeah. Amanda, maybe you can draw a line from the all-time high, a trend line lower, and attach it to that, that March high, if you will, or not the March high, but that little blip that we had.
Right above the 200-day. We're probably right up against it-ish.
Yeah. And I guess, you just mentioned sentiment. You mentioned volatility. You mentioned technicals. I think these are all really important. Why are we thinking about technicals? Well, on a day like today, it's just a great example of, algos, just key in on some of this stuff, right? And you get some of these, we've been talking about this for a week now. Some of those sentiment indicators were as bearish as they've been in decades or this or that or whatever. So you get those rallies. I also remember, Guy, that we were drawing, if Amanda wants to draw those lines, I don't know. Hey, by the way, Guy, how's Amanda doing?
Amanda's great.
Okay.
There you go. She did it. That's it.
Okay. So, I mean, this will be interesting to see what happens. I remember that after we had that fairly precipitous drop, from late February into March, I know you specifically thought we get a move back towards that 5,800. It almost got there. It didn't. It failed at its 200-day moving average. It basically made the second point of this downtrend. So let's move the chart over to the left a little bit, and just so we can see. Okay, so let's see what happens here. A big 3-day move off the Monday lows into today. And to your point, maybe that downtrend's not that important, but maybe 5,600, Guy, is it's the new 5,800, I guess, from this downturn.
Look, but the counter trend moves in what I think is, again, I want to be clear. What I think we are in right now, the counter trend moves higher are violent. We're seeing it now. We've said that for a while, that it's not going to be a straight line lower. The 50-day, as you see crystal clear, has crossed the 200-day to the downside. That does not happen all that often, whether it's to the upside or the downside. That is in place. Can the market rally under those circumstances? Absolutely. But that is one of those things you have to respect. I would be shocked if somehow this market just accelerated higher, exploded higher, and that entire thing reversed itself and the 50 crossed back through the 200-day to the upside. I don't think that's going to happen. Is there a chance? Yeah, in this environment, there's a chance. But I think, again, what's taken place and finally some gravity is taking hold of the market and the inevitable slowdown is upon us. And the market, to me, is challenged for a number of different reasons, the most important of which there's no valuation cushion yet. And, we could talk about where that is, but it's not at 54.50.
Yeah. I just want to, before we get to some more macro stuff, what you just talked about, the volatility below the 200-day and the S&P. Let's pull up an Amazon chart here for a second, because I just want to highlight, some of the stuff that's going on in the Mag 7, which is obviously some of the hardest hit names in this entire market. I mean, this stock was up 8%. Now it's up 6.5%. Just look at that little blip. You know what I mean? It's really, 8%. It's not, doesn't look meaningful. You know what I mean? And I think just that's an optics thing. You have their 50-day. It's about to cross below the 200-day. And I just want to highlight, there's a lot of stocks like that. Let's pull up Blackstone BX for a second. So a friend of ours, Jeff, a friend of the pod, Jeff Richards, he and I were talking about some of these PE names last week, how hard hit they were. He's starting to pick at them. If he could have bought a basket down here, he would have, if there's a nice little ETF. So look at that. Okay. Pull up APO, Apollo, right? And look at how much the 50-day, how much further it is below the 200-day. This one's just going lower. Maybe this one looks a little different, but they're back up towards those, downtrends that have been in place for months now. Those things topped out, well before the S&P topped out. So I just wanted to highlight the fact that, yeah, you're getting some big moves. I'm looking at my main fact set screen, guy, and it's just a sea of green. And we're seeing some big one-day moves for individual names. But I think it's important to put them in some context of, where they were a few months ago, and just how widened the volatility bands are, and how vulnerable, stocks like this can be if they start to lose, some of these gains, because you fill in gaps at this point, whether it's a big tech stock or a financial stock, that becomes a problem to the downside if you're filling in gaps.
Listen, you just said it. The fundamental story is deteriorating, and the technical story has been breaking down as well. And we're highlighting it here. Again, we're showing you things that don't really happen. And what I think we're seeing is, a potential sort of trace back, or, move back towards what should be extraordinarily huge resistance on the upside in individual names and in the broader indices, without question. And then we'll see how we perform from there. Real quick, because we do have questions. Chris L is asking about Netflix. So look, I think if you watch Fast Money, if you watch Dan and I think we've been pretty consistent about Netflix. And look, Netflix obviously had a pretty couple different significant downturns. From February of this year, it traded from like 1060. I think it traded all the way down to about 850 or so. We saw it in December of 2024. So we've seen moves to the downside. But all along, Netflix, when it does find those levels, it reaccelerates. And I think today or yesterday, either or, we made a new all-time high at sort of 1065 or thereabouts. So I understand why people would want to sort of run out of the way here in Netflix and say it's too expensive. And I get it. I just think Netflix wins right now. And unless you have a market deterioration here in the United States where really bad things are happening, I just think Netflix is going to be sort of one of these last stocks standing, I should say.
Yeah, because it's also going to be one of the last streaming apps that you cancel, right? And listen, I want to be really clear on this. You've been all over this. I have, Thursday after the report came out, I thought the quarter was good. It wasn't like a blowout. You don't have the headlines of, beating subscribers in North America by this, and like they're done doing that. So I think after the rally the stock had, I think it's interesting that it's taken a pause at that prior all-time high. And I know it made a brief new one, but we just spent a lot of time talking about 200-day moving averages on a lot of indices or individual names. This one never broke it. Think about that. It'd be interesting screen to see how many have actually stayed above that 200-day moving average in the S&P 500. Maybe we'll get our main man Carter to do a little work on that. Guy, I want to go back to something that you just mentioned about deterioration in the economy. And Axios has a report out this morning. U.S. trade is already falling, and it was talking about shipping rates, and it's talking about and we'll put this in the show notes. I think this is really important. I think there's lots of other things to kind of key on to get a sense of what might be like the kind of warning signs of a slowing global economy. We talked a little bit about the IMF cutting the global growth rate from 3.3% to 2.8% yesterday, and the US, I think, from 2.8% to 1.7%. And again, I have no idea what the track record is of the IMF. I think those headlines are worth keeping an eye on. It just seems directional in a way. But look at, shipping, look at rates, look at what some of the activity that's going on. I think those are some really good indications, because once you start canceling this sort of stuff, once you get huge bottlenecks, whether they be in Asia or here at these big ports and stuff like that, it's really hard to turn that around. And so you could say to yourself, okay, but if we get big deals, then we'll get more clarity and we'll work it out. I just want to go back to 2018, 19, and early 2020. That's how long it took to do a deal with China. And right now, we are trying to negotiate 60 or 70 bilateral deals. So I think, these sorts of headlines are great, but we need to back them up with action. And until we have that, I think you're going to continue to see this sort of volatility in markets.
Yeah. Agreed. And again, it comes down to the fundamental deterioration of all the things that are going on. Basically, then I think exaggerated or exacerbated by, all this news about tariffs and what is apparently, although pulled, maybe ratcheted back, it is a global trade war that I think that everybody's starting to deal with. And that's going to have impact. And as much as people want to say the market will recover from this, I think it will recover from this. I think it will recover from this at lower levels. And both the fundamental damage has been done. Now the technical damage has been done as well. One thing where you're seeing some pressure today is gold. And we have a question about Newmont Mining that I will address, but let's pull up a gold chart, because I don't think it's surprising that gold is giving some stuff back today, given the run that it's had. And listen, this last little move in the gold market was probably sort of accelerated by all those Jerome Powell headlines. And if those headlines are now started being walked back, well, you're going to subsequently give back some of that gold move. But I will tell you, this is just me, I'm actually sort of encouraged by how well it's hanging in there. I mean, listen, tomorrow we could have a much different conversation. But in the here and now, gold still performs like a champ. And I said it last night, I'll say it here. You're still looking for opportunities here to re-engage or get back in or add to, whatever word you want to use, the gold market. Because in my opinion, Dan, this story is not over. And real quick, throw up a Newmont Mining chart, which, like a lot of the miners, has had a run. And the questions from Chris, I think it's from C.R. Taylor, is Newmont finally going to quit itself on the earnings front? The short answer is probably no. And if you go all the way back to that line job in the fall of last year, where the stock went from about that one, keep going over, Amanda, that one right there, that was on the back of earnings. And I said it at the time that, wow, what an exaggerated move to the downside, only then to watch the stock fall even more into early this year. It was shocking to me how shitty that stock traded. Got back on the horse, traded back to those levels, and now here we are. So I am not particularly optimistic about Newmont, because quite frankly, they're not one of the better operators out there in the space.
Yeah, let's pull can I pull up that gold chart for a second, Guy? And I like the way you kind of phrased it. It's like, runaway breakouts are they're really hard to sustain, right? And we saw that. And so I think, if anything, gold was a great indicator of the sort of level of panic. I think I'm just going to channel my inner Brian Kelly, or we like to call him BK, that maybe gold was the new VIX, if you think about it, during this period, right? And, so you had that move yesterday. I mean, it was like made a beeline for what, 3,500 or something like that. It didn't close near those highs. And, if you were just to kind of draw an uptrend from those kind of, I want to say January or December sort of lows, I mean, you get some levels. You see that rising 50-day moving average. You see how much, above its 200-day moving average is. And, maybe that's something that, on an overshoot to the downside, Guy, I mean, you have to reload the crap out of it, because, again, I think this kind of old U.S. exceptionalism sort of situation is just not going to abate after we have some, kind of handshake deal with the Chinese that we're going to do this stuff. Because if anything, the back and forth has really, I think it's really cut into the confidence of the global, our allies and our adversaries and that sort of thing. So I think, to your point, I think gold is kind of a reload. I'm probably lower than you are.
Yep.
You know what I mean? but
And
you
you're
know
probably going to be right. Yeah.
well, no, but I mean, like, we're drawing those lines right there. It's the 50 and it's that uptrend,
Mhm.
you know what I mean, for this year. And this, if you were looking at anything else and you can take the macro out of it, the dollar movements, you know, all the other stuff that we've been talking about, I'd say, all right, well, I think you know where to buy it. It's probably like 3,100 or something like that.
So, and yes, and that is, I think, and that's a level, and then maybe the 200-day, which has not come into play in a while. I just don't think we're going to get down to the 200-day. Real quick, Amanda points out correctly, put that Newmont mining chart back up. Here's an example where you have the 50-day crossing the 200-day to the upside. So as Amanda correctly points out, this is a golden cross, but go back and look. This comes on the heels of what was a death cross at the end of last year, early this year. So Newmont Mining can't figure it out. Real quick from Donna, is this sell all rallies? And Donna, I think the answer is yes. And you know, again, you have to I think you have to define what a rally is. Like, where does this thing exhaust itself? And we talked about levels earlier in the S&P. You know, I think, you know, do you have a chance to get to 5,700? Maybe ish. I think 50 is going to be pretty big resistance. But yeah, I think it's a bit of a paradigm shift in terms of the market. I think rallies are going to be sold. And now, real quick from Ramesh, is there a correlation between gold and the US dollar? And the answer to that is historically, yes. I think there's been somewhat of a decoupling there, as I pointed out a number of times, Dan has as well. You know, gold's been doing well theoretically or seemingly in every environment, up dollar, down dollar, bond market, non-bond market, equity market. You know, there've been days where you've had risk-off events where gold is not spared, but gold's hanging in there like a champ. So although gold typically does its best when the dollar is melting down, I don't necessarily, Ramesh, think it needs to happen for gold to continue. That's just me, Dan.
Yeah, I mean, again, I just say that if gold was higher today, if it was, you know, closed, you know, that'd be a real problem, you know, from a sentiment standpoint, in my opinion. So again, a pretty interesting one. Let's look at the dollar here, guy, because this is the US dollar index. That would be the Dixie, which seemed to be a one-way sort of train here. And you know, this is one where, you know, could this thing rally to, you know, 102, 103 and like nothing? Yeah. The volatility, though, you know, in the US dollar is concerning. I mean, you say it all the time about, you know, treasury yields. You could say they're kind of attached to the hip. This time around, they actually have been going the opposite way that you might have thought, you know, given this sort of situation here. But I don't know. I mean, like, it seems like this would be one where maybe you want to sell rallies, especially if you get sort of that downtrend, which is going to basically line up with that 50-day moving average. So it's almost the opposite of gold, the way we were talking about that.
You know, I'll say this. You know, if you had told me yesterday what was going to transpire, as I said earlier, about 5:30, and then you said, okay, what's going to be the knee-jerk reaction? I probably would have gotten the S&P right. Probably would have gotten gold right, bond market right. I would have thought the dollar, given the sell-off, would have been performing a lot better, and it's not, which should concern. Again, this is just, you know, a few hours into this thing, but it should be concerning. So I think your point is well taken. The dollar should be performing here, and it's not. And I think the people are still looking for opportunities to sell, be short the dollar against just everything else they can find. And I think our interview with Danielle DiMartino Booth either dropped or is going to drop today, and she spoke about exactly that, you know, people are trying to find ways to exhibit a short dollar position. And today's performance, I think, is part and parcel to what she's talking about. It's not a good performance, I guess, is my point.
Yeah. Here, there's more. Hold on. Let me just do this. Headlines pass. Besant, no unilateral offer from Trump to cut China tariffs. Well, I mean, that's the point. Do you see that headline? So yesterday at 5:35, he's saying we're going to be nice.
Mm-hmm.
We're going to cut the rates dramatically. We're going to be nice. They're going to be nice to us. Are we negotiating this in, like, you know, I don't even know what to say, in like sixth grade, you know, what do they call that? United Nations, where the kids get together and they take up you know what I mean, a country and this and that, or whatever, you know, and they debate this sort of stuff. But the fact that Besant's coming out, you know, 14 hours later and saying no unilateral offer from Trump to cut. So part of this has to do with the fact what we were just talking about, Guy. I mean, you need to make some threats in a negotiation that have teeth to it, right? And so this is a situation where back and forth between the president, the Treasury Secretary, the Commerce Secretary, like this is just not good for our negotiating position. Can we talk about yields for a second here? Because the volatility in the last, I don't know, just look at what happened today. I mean, we traded 4.25 in the 10-year, and now here we are at nearly 4.35. That's kind of nuts.
Listen, again, there's a lot happening here for sure. And my view on, so I don't want to bore the shit out of people, but I just look at TLT and I will continue to say we're headed towards the levels that we saw in the fall of 2023. And whatever that level is, and I think it comes in around 82 or so. If you try to figure out, I think 10-year yields at that point will be north of 485 or 490. Now, people will say correctly that we've been there before historically. It's not a big deal. Yes, there's truth to that, but it's the speed with which, and it's what it's trying to tell you. In the same way, what's the gold market trying to tell you? What's the weakness in the dollar trying to tell you? It's all part of a similar narrative of people trying to get away from U.S.-based assets. And I think that, again, my opinion, problematic. There was an auction yesterday that didn't go particularly well. We'll see how the subsequent auctions are. So, I find myself in a minority. I get it. Some days I look smart, amazingly. Other days I don't look smart, not surprisingly. But I think yields go higher from here. And, you can then make any, in terms of, you can make any not reference, but you can make any investment decision based on that. I think higher rates are a bad thing for the market, Dan.
Yeah, what I meant to say is model UN.
Model UN. I see that Jacob just sent that. Genius.
All right, so on days like today, this because I probably bore the hell out of people. I love to see what's going the opposite way of the major trend. Let's look at Walmart. Maybe Amanda can pull up a one-day chart there. Just went down on the day. It was trading, the 96.60 was the high. Okay, 94.80. It's not the end of the world. You know what I mean? That sort of thing. But it's red. Target's red. Costco's red. You want to mine these gaps, and you could say, well, you're just cherry picking, right? You're just picked a handful of names. There's a couple names that I want to keep a close eye on. JP Morgan, maybe pull up the intraday. Okay, it's up 3.4%. That's great. Let's see, how
where
exhausted to the upside, right? Amazon, which we just mentioned, was up 8%. Now it's up 5.7%. You know what I mean? Let's keep an eye on some of these. Tesla we're going to hit in a second, but Nvidia has dropped, from its highs. So there's plenty of names, you know what I mean, that we want to keep a focus on. American Express might be one that's interesting to me. We just talked about some of those PE stocks. Let's look at Blackstone, where that is now relative to where when it opened up, earlier today. Look at that. I mean, Guy, Blackstone traded $134. It's trading at 128.5. If these stocks fill in those gaps, then the S&P is going to have a really hard time, holding this sort of gain. So that's just how I think.
Listen, I'm with you. If you look at it now, I mean, I think when we started this, you just mentioned the headline, but I think when we started this podcast, the S&P was, I think, 54.50, and we've sold off about 50 handles, which, again, I don't want to make a big deal out of it because 50 handles in this environment is not what it used to be, but you have to pay attention to what's going on. By the way, what I didn't mention earlier was, and we'll get to this in a minute, if it's Wednesday, it's Butters. And I'm sorry, in my sort of excitement to get to the show, I sort of blew past that. But we have to talk about Tesla real quick because obviously they reported, and I think we were pretty accurate in terms of how lousy a quarter it was going to be. But I think we were equally accurate to say you're not pushing against this sort of 220 level, which had been support for a number of times since March, and obviously was a level we sort of traded down to, I want to say, in the fall of last year. Now, this rally to me today, and this is just me, although it's up 7%, there's something that's just unenthusiastic about that, if I may choose that term. So let's see how Tesla closes, because, again, not a great quarter. We had the futurist on last night from ARK Invest talking about us missing the point, and that may be true. I don't know. We'll see. There's obviously a lot of hope around robo-taxis and self-driving cars, and maybe that's all it really comes down to. But in the here and now, that's a challenged business model.
Dude, all right, I'm just gonna say this. That guy is so full of shit. You know, I mean, he's the head futurist of ARK Investments. Let's pull up ARK for a second. AR, what is it, KK or whatever the heck it is. I mean, this is, and I've been saying this for like 4 years. This ETF is the island of misfit tech toys. It's just, let's pull up a 5-year for a second. I mean, who the hell is paying these people any management fee to do this? You could throw a freaking dart at your, at your FactSet machine and hit a couple stocks that are going to outperform this thing over that same time period. And to have this guy come out and say this, the company pulled their guidance for the year. The company's earnings were down 70% year over year. The company is going to miss their delivery numbers for the 3rd year in a row, and they're going to be declining for 3 consecutive years. The CEO of the company, who by all means has pushed EV adoption, in a pace in which we never would have seen if he didn't exist. I think he is telling us that the competitive advantages that this company has had in the EV space over the last 10 years are gone. Okay. And you highlighted it yesterday on Fast Money. Their operating margin got cut in half. It is at 2.5%. Their auto gross margins, which they did not give, Guy, are probably 10%. If the
When you
president,
back up credits, yeah.
If the president has its way and you get rid of the emission credits that they sell and you get rid of the consumer credits that they get, the $7,500 on most of their cars, they're done. I mean, literally, they're done. And then when you think about in places outside, and I don't mean done like they're going out of business. I mean, like from a competitive standpoint, because they are not competitive in China anymore. They're getting less competitive in the EU. They're less competitive here. And so I just think that look over there, not here. Look at Robotaxi, which is, I'm going to take the over all day long. Look at the way he described Robotaxi yesterday, this futurist, was the dumbest thing I've ever heard in my life. And I think I said it on the show. It's pure science fiction. You know what else is science fiction? Robots. $30,000 robots. So I don't know who the hell is, buying into this company at $800 billion market cap, but have a ball.
It's not science fiction. That would be John Butters, Dan. And you do such a great job of introducing him.
Really? Okay. We have a great partner in FactSet. They've been with us, Guy, I think since day one of Risk Reversal Media. They are our head data partner, but we also have the benefit of, the thought leaders. And one of those thought leaders, which you've known for a very long time, and I've known for a long time, I've been reading his work, John Butters, the senior earnings analyst at FactSet. He writes every week the Earnings Insight blog. You can get it at factset.com/insight/subscribe. You can have it Friday mornings in your inbox, like I just said, but we get to preview it on Wednesdays. I think this time of year, Guy, is about as important as it ever is, and that would be in earnings season. So let's focus a little bit on what John Butters is highlighting here. The blended, which includes actuals plus estimates, net profit margin for the S&P 500 for Q1 2025 is 12.1%. This number reflects a quarter-over-quarter decrease, but a year-over-year increase. Analysts currently predict higher net profit margins for the rest of 2025. 5 sectors are reporting a year-over-year increase in net profit margins for Q1, led by healthcare, surprising to me. 6 sectors are reporting a year-over-year decrease in net profit margins for Q1, led by real estate and energy. Guy, before we get to some of the sectors and breaking those down, what about the 12.1% Q1 2025 blended profit margin?
I think it's, again, I think profit margins are great when you can pass on costs, right? But profit margins get challenged when you're no longer able to do that for a number of different reasons, not least of which a consumer that's probably strapped. On top of which, obviously, again, this global trade war where there's an unknown in terms of what your costs are going to be. So I look at this and say, there's no conceivable way, in my opinion, that profit margins can come in nearly as robustly as people are thinking or looking for, again, a number of different reasons. And again, that piggybacks everything we've said about earnings estimates as well. So I feel, and I'm not saying I'm correct, but I think we're into an area where You're going to decline in earnings, on top of which you're going to see declining margins as well, which is not a particularly healthy brew. It's something we probably haven't seen, Dan, if I had to guess, since the height of COVID.
Yeah, no doubt. And then, this kind of struck me, as I just mentioned, Guy. So if you're thinking about the rest of the year, currently predict higher net profit margins for the rest of 2025. So how does that happen based on exactly what you just said, right? So companies, if we do have a protracted kind of trade war here, you see weakening demand. If you're a company selling goods and services, you got to figure out ways to keep demand at a level, right? You don't want to cede market share to competitors and the like. So you have a choice. If you're a good operator, you try to eat as much, right? This would maybe be a Walmart or something like that, which is one of the reasons why we maybe saw some outperformance over the last week, when things were kind of going haywire in the stock market. It was kind of hanging in there. So you either can eat as much of that increased cost and keep market share, right? Or pass it through to the consumer and run the risk of consumers going to other places, right? And you can make some of the same kind of arguments for enterprise and the like here for businesses. So I think that is probably a bit optimistic, Guy. What do you think about that?
I think it's more than optimistic. I think it's sort of pie in the sky. And I think, I don't know what's going to necessarily happen this quarter, because again, as everybody here knows, but it's important to point out, this is all obviously backward looking, but moving forward from here, I think you're going to see decelerations and things of the magnitudes we haven't seen for quite some time. And people are going to come to the realization that the earnings outlook is way too exuberant. The margin outlook, definitely the same way. And again, with deterioration in margins, what are companies going to start to do? I mean, we've said this a number of times. You're going to start to see layoffs. And I'm not trying to be, draconian in any way, but that's just historically, if you look, that's just a normal part of the business cycle. That actually does happen from time to time. It's not unprecedented, and I'm surprised it hasn't happened yet. But I won't be surprised if it does take place over the next few months.
Yeah. All right. Well, listen, you know where to find John's work. We appreciate it. We appreciate getting a little preview of that. FactSet.com/insight/subscribe to get it in your inbox on Friday mornings. Guy, we got to go to crude for a second here, because this is one which we might have kind of lumped into the macro conversation that we just had here, but declining today 2.5%. I think that's what it was down. It's kind of surprising in this environment, because if you think about what's going on with stocks and yields and that sort of thing, you would have thought that dollar would be reflective of maybe a risk on sort of trade. You see the trend line that I drew. Maybe it's important, maybe it's not. We bounced off of it on the lower end, and I was just kind of attaching it to last summer's highs, and then you saw the downtrend, which is pretty easy to kind of draw. I think we're kind of right in the middle of that downtrend, so maybe it's insignificant. The reasons for today's decline, OPEC plus kind of turning on some more production, at least that's what they're signaling. So thoughts really quickly. You're the crude guy.
Well, again, disappointing in a word, the performance of the commodity, equally disappointing in the performance of the equities. Not surprising that OPEC has decided, they're going to sort of open the spigots up, because quite frankly, that a certain crude oil price actually hurts us to the downside. And I think, if I had to guess, that's probably what they're pushing for. If you go back and look at the first Trump administration, there was actually a point in time where he went to OPEC and talked to them about not sort of accelerating production, but cutting production, because the crude oil price was too low. Go back and find it. It absolutely happened. So we dance a very fine line here in the United States with the price of crude. 65 to 70 probably is the sweet spot. Anything south of 60 and our energy business gets hurt in a pretty meaningful way. And I think, if I had to guess, that's what the OPEC people are trying to push for. So it goes down to, we say all the time, be careful what you wish for, because sometimes you might get it. And we might get it in the form of lower crude prices, Dan.
Another name really quickly. I know we got to get out of here. I just wanted to highlight Guy because this went. Let's pull up Meta for a second. I think you and I were kind of scratching our heads, in January into February, it had those 20 consecutive days that the stock closed higher. It was just such an outperformer relative to the rest of the Mag 7. It seemed like a very curious situation. A lot of folks, just seem to be piling into this one as the picks and shovels trade. That would be the Nvidia, and like kind of was cooling out a little bit. But now it's one of the hardest hit names from those recent highs, right into their earnings events, down 30%. And again, look at it. Fine. It's up 5% today. Seems like a nice little rally there, but still not out of the woods. And, MoffettNathanson had a call yesterday talking about, so Temu and Shein, these are these kind of fast fashion-y retailers. When I say fast fashion, they sell, low end goods. They ship them to the US. They fell under this de minimis rule where, they were avoiding tariffs and some other restrictions as it relates to, shipping from China, and the Trump administration is threatening getting away with that, or maybe they've already pulled it. And those two companies advertise billions of dollars on, Facebook and Instagram next to the US. China, this is not one that you would have thought is going to be in the sights, right, of a trade war. They don't have operations in China. And, if they were to lose maybe $7 billion in sales this year, that's obviously advertising. These are the sort of knock-on effects where you just kind of have to dig a little bit to see, it's not just industrials and manufacturers and that sort of thing. Here's a digital company that has no presence in China, but could be massively adverse affected by Chinese companies that are advertising on their platforms here in the U.S. I just want to
other factors as well. It doesn't help that, despite the fact that Mark Zuckerberg brought himself up to the inauguration and paid the amount of money he did, he is being subject to things that he probably thought he was going to be exempt from. So there's that sort of overhang as well. And listen, we've said this 100 times. As great as a company as Facebook is, they will not be protected from a downturn in the economy when 70% of their advertisers are probably small and medium-sized businesses, which are right now right in the middle of the crosshairs of everything that we talk about.
All right. We covered a lot of ground here. Let's see how we close. Mind those gaps, people. Listen, I'm not wishing for a lower. I just would like to have better messaging that could give investors, that could give companies, that could, just calm things down a little bit, right? And get the macro not kind of freaking out on every sort of headline here and there. And, the one thing I'll just mention, the Chinese haven't been making any noise about this. The Canadians, the Mexicans, the EU, everyone's kind of sitting on their hands. Maybe they're doing some great negotiating in the background. I don't believe the White House has the sort of discipline to not share that sort of, if there's anything good coming out of it. So, you better kind of strap in here a little, because I think it might take a lot longer than the markets today and yesterday are suggesting that we might have some resolution.
Yeah, I agree with that. And that's why, again, regardless of what you think, the VIX is going to continue to tell the story. You have a VIX that's still, again, north of 27, 28. This is elevated for a prolonged period of time, which suggests that moves of the magnitude we're seeing to the upside and downside are not over by any stretch. Anyway, check out that interview we did with Danielle DiMartino Booth, which is dropping now, I believe, on YouTube. We'll be back tomorrow on Market Call at 11. See you later, folks.
All right. See you, everyone. Thanks.